So, let's talk about GDP. It stands for Gross Domestic Product, which honestly sounds like something you'd find on a can of suspiciously cheap meat. But it's actually the most important number in economics. Think of it as a country's economic report card. It measures the total value of everything a country produces and sells in a year. Every car, every smartphone, every overpriced latte. It's the big, flashy number that politicians love to wave around to show how well they're doing. A rising GDP suggests a healthy, growing economy where businesses are thriving, people have jobs, and everyone is, at least in theory, better off. It's the metric that gets you on the front page of financial newspapers. The reason everyone, from world leaders to your uncle who suddenly knows about stocks, obsesses over GDP is because it influences almost everything. When GDP is high, governments can spend more on things like hospitals and schools. Companies are more likely to invest and hire new people, which means more opportunities for everyone. It also affects a country's power on the world stage. A massive GDP gives a nation a lot of clout in international negotiations, trade deals, and global politics. It's the economic equivalent of having the biggest stick in the playground, which makes it a very, very big deal when that number might not be, shall we say, entirely accurate. Now, calculating this number is a monumental task. It involves adding up every single economic activity, from massive infrastructure projects down to the humble corner store selling snacks. For a country as vast and complex as China, this process is even more of a headache. The National Bureau of Statistics of China is the official scorekeeper, responsible for collecting data from every province and industry to produce that final, headline-grabbing figure. This number is then broadcast to the world, signaling China's economic health and its trajectory as a global superpower. It's a number that everyone from Wall Street to Washington watches with bated breath. But here's the rub. What if that report card has been, for lack of a better term, photoshopped? What if the student has been giving themselves an A+ when their actual performance is more of a solid C? This is the central question surrounding China's GDP figures. For years, independent experts, economists, and analysts have been looking at China's official numbers with a healthy dose of skepticism. They argue that the smooth, consistently high growth rates reported by the government don't quite match the messier reality on the ground. And when a number that important is in question, it creates a fog of uncertainty that affects us all. When you look at China's official GDP growth, it often looks suspiciously perfect. For 2023, the government announced a growth rate of 5.2%, a number that just so happened to meet its target. However, independent research groups paint a very different picture. The Rhodium Group, for instance, estimated that the real growth was likely closer to 2.4% to 2.8%. That's not a small rounding error, it's a massive gap. It's like telling your friends you ran a marathon when you actually just jogged to the end of your driveway and back. For years, some economists have suggested that China's GDP might be overstated by as much as 3 percentage points annually. This discrepancy isn't just an academic debate, it has real-world implications. If China's economy is actually 10% smaller than we think, that's about $1.7 trillion of economic activity that simply doesn't exist. This gap between official claims and independent analysis comes from a deep-seated distrust in the official data. The National Bureau of Statistics is a government agency, and there's a strong political incentive for provinces and the central government to report good news. Local officials are often promoted based on meeting economic targets, creating what some call a man-made GDP figure, where the numbers are engineered to fit a predetermined narrative of success. The government's own actions often contradict its rosy economic pronouncements. If the economy was truly humming along at over 5% growth, you wouldn't expect the government to be pulling out all the emergency stops. Yet in recent years, China has implemented aggressive interest rate cuts, launched massive local government debt refinancing programs, and injected huge amounts of liquidity into the financial system. These are not the actions of a government overseeing a robust, healthy economy. These are the frantic moves of a government trying to prop up an economy that is clearly struggling with significant headwinds, something the official GDP numbers conveniently fail to reflect. This leads to a situation where there are two parallel narratives. On one hand, you have the official government story, full of impressive statistics and confident proclamations of stable growth. On the other hand, you have a story pieced together by outside observers, which points to deflation, falling prices, and a significant slowdown. While the government highlights positive figures like real GDP growth, it tends to downplay or ignore negative indicators like slowing nominal GDP, which includes inflation, and declining fiscal revenue. It's a masterclass in selective storytelling, designed to project an image of strength and stability, regardless of the underlying reality. So, if you can't trust the headline number, how do you get a sense of what's really going on? You become a detective. Instead of just looking at GDP, analysts look at ground-level data that is much harder to manipulate. Take cement production, for example. Cement is the literal foundation of construction and infrastructure, two massive drivers of China's economy. In 2024, while official investment figures looked okay, cement output dropped by over 10%. You can't build ghost cities with imaginary cement. This single data point suggests that the construction sector, a huge part of the economy, was in serious trouble, a fact not fully captured in the official GDP. Another crucial clue is consumer behavior. The government might report strong household consumption, but the evidence on the ground tells a different story. Consumer confidence has been stuck at all-time lows, meaning people are worried about the future and are not spending money. Major e-commerce giants like JD and Tmall, which are basically the Chinese equivalents of Amazon, reported a 3% drop in sales. When people aren't buying things online, one of the most popular forms of shopping, it's a clear sign that consumption is weak. This contrasts sharply with official figures that claim consumption was a major contributor to GDP growth. Then there's the government's addiction to stimulus. To keep the growth numbers looking good, Beijing has repeatedly resorted to massive spending packages. For 2025, the government plans to raise its budget deficit and issue trillions in special bonds to fund projects. While this can temporarily boost GDP, it's like drinking 10 espressos to stay awake. It works for a bit, but it doesn't solve the underlying exhaustion. This constant need for stimulus shows that the organic, private sector parts of the economy, like small businesses and private investment, are struggling. The government is essentially stepping in to fill the gap, creating growth that isn't sustainable in the long run. Ultimately, by cross-referencing these alternative data points, credit growth, freight traffic, electricity consumption, import and export figures, a more realistic mosaic of the Chinese economy emerges. It's one where net exports are propping up the numbers because domestic demand is too weak to absorb the country's massive industrial output. This leads to a situation where China is exporting its overcapacity to the rest of the world. The official data presents a picture of a well-oiled machine, but the detective work reveals an engine that is sputtering, kept running only by constant government intervention and a selective presentation of the facts. So why should anyone outside of China care if its GDP numbers are a work of fiction? The simple answer is that in our deeply interconnected world, China's economy doesn't just stay in China. It's the second largest economy on the planet, a manufacturing powerhouse and a huge consumer of goods from all over the globe. If China's economy sneezes, the rest of the world doesn't just catch a cold, it risks getting pneumonia. International companies that have invested billions in China based on rosy growth forecasts could find themselves in deep trouble if the market is actually much smaller and weaker than they were led to believe. For the people of China, the consequences are even more direct. An inaccurate picture of the economy can lead to poor policy decisions. If the government believes its own hype and fails to address deep-seated structural issues, like the property crisis, mountains of local government debt, and weak private sector confidence, it only delays the inevitable reckoning. Real people are affected by this. Slow wage growth, a precarious job market, and the negative wealth effect from a collapsing property market are all consequences of an economy that is not as strong as the official numbers claim. Pretending everything is fine doesn't fix the underlying problems. Furthermore, the lack of trustworthy data creates immense uncertainty for the global financial system. International bodies like the IMF often have to work with the official numbers while privately acknowledging the risks. Global investors need reliable data to make sound decisions about where to put their money. When they can't trust the numbers coming out of a major economic power, they become more cautious, which can stifle investment and slow down global growth. This data fog makes it harder for everyone, from central bankers to small business owners, to plan for the future, creating instability that benefits no one. In the end, transparency is not just an abstract ideal, it's a practical necessity for a stable and prosperous global economy. Accurate economic data builds trust, both domestically and internationally. It allows for better policymaking, more informed investment decisions, and a clearer understanding of the challenges and opportunities that lie ahead. While the allure of presenting a perfect growth story is strong, the long-term costs of hiding the truth are far greater. For China to truly secure its place as a stable, responsible global leader, it will need to start with something fundamental: telling the truth about its economy, warts and all.